Arthur, can we perhaps quickly touch on currency weakness? So the rand's recent weakness, and there's, I suppose, lazy analysts would point to the obvious culprits being grey listing, anemic growth, corruption, all of these things that's causing weakness in the rand. But I think a more sober look at this would consider a broader view. I think we've come to know that what drives the rand is not really what happens internally, which is a strange comment if you don't come from South Africa, is that the rand is very much a reflection of what's happening globally and with asset movements there. Now, current rand weakness, what do you attribute that to? And what is your outlook on the rand? I know it's a dreaded question for any macroeconomist to ask what's going to happen to the rand, but what are you seeing structurally causing the weakness of the rand? I mean, is it internal? Is it external? How are you seeing that?
Nico, so if you look at the rand dollar, it's one of those currencies. It's certainly not the case for all currencies, but it is one of those currencies in the very longer term does in fact, drift along with inflation in line with inflation differentials. But it does deviate for long periods of time, and sharply so, and could be for years. And those deviations typically come during times when global financial conditions are tightening. So the Fed matters when the Fed is raising interest rates, and the other one, of course, is when commodity prices are moving. So, if you've got high commodity prices, it tends to support the currency. And what we've had over the last, we had that for a while, post the pandemic, when commodity prices recovered and the rand recovered along with those commodity prices. And then through that half of last year, when commodity prices started to fall, export commodity prices, and the currency came under some pressure. The Fed also then, tightening more than anticipated generally by the market. And so, those two factors, I think, are weighing on driving the currency away from that long-term trend. There is an add-on, and the add-on is, is electricity at the end of the day. Because why? Because electricity damages growth prospects. So again, you're not seeing a huge attraction for capital coming into the economy if growth prospects are very poor. And then at the same time, the grey listing probably to a degree, although it's quite difficult to show that empirically. But you're quite right. So you don't lose sight of the fundamental drivers, because that's quite important going forward as to where the currency is going to go. So historically, when you have seen the rand weaken very sharply, sustained period of time, the turning point is normally when the Reserve Bank has tightened sufficiently to compensate and to maintain and to bring down long-term inflation expectations and inflation outlook. That's normally a good anchor for the currency, and then you normally see the currency coming back quite nicely over the next couple of years. It does help if commodity prices are stronger. So there it's a bit more difficult, because what we have had globally is a dearth of fixed investment in mining relative to GDP for many years, and so you've got this lack of supply. So even in a demand environment that's not especially strong, there is a level of support for commodity prices. China, that economy seems to be opening up. The general expectation is going to do a lot better this year. That might be not a longer term thing, but in this current year you might see significantly higher growth, and that could be supportive. You've got to weigh that up against potentially what happens in the US. But there may be some support for commodity prices, in which case so a combination of the SARB tightening and commodity prices holding up or getting maybe some improvement. Your base case is that given that the rand is so cheap at this point, that over the next couple of years it could strengthen. Yes, there are always things that could drive it away or keep it undervalued for a longer period of time, and we know what they are. Particularly electricity is probably the most important one. So what you've got to hope on that front is that into next year, if you look at the plans to bring supply online, if you get a significant amount of that, and because there's a huge amount of megawatts that are planned to come online over the next 18 months, you just have to get maybe half of that to alleviate a lot of the pressures that we're seeing now, and suddenly you're looking better next year off a very weak base this year. So with the currency this week, as I say, you can't predict the future, but based on those observations, we would ordinarily sit here and say, well, you know what, we think this currency should do a lot better on a 1 to 2 year view.
And you mentioned the Reserve Bank. So, a lot of people might argue that we are following the Fed. We had kind of raising rates in lockstep and causing some disconnect between the inflation rate and where our rates are going. Do you see that as plausible? I mean, to what extent do you think the inflation and currency stability should remain the main thing for the Reserve Bank, or should they start considering a wider impact of their monetary policy? What's your views on that?
So I've said the Fed matters, and the Fed does matter, but the Reserve Bank, our Reserve Bank is a very effective inflation targeter. They started hiking quite early, and they hiked quite aggressively when they needed to. And I think it was coming off a very low base, we've got to remember that, but they did move quite early and quite quickly, and so we've got to remember that they've come a fairly long way already. My own personal feeling is that, we're a small open economy, we are price takers in the world, and the currency is extremely volatile as a result of it. And so factors that have a big influence on consumer price inflation in South Africa is because we're still an emerging market. So things like food has a high weighting in the overall basket. We find that, currency movements filter through very quickly into inflation expectations. And it's difficult enough to maintain your inflation target against that backdrop. To add something on like a growth objective, which is sort of being suggested now, would be make it life very difficult for the SARB, especially since it is really not monetary policy that's the growth problem, causing the growth problem in South Africa. In fact, I think that it's made a positive contribution by bringing down inflation under an inflation targeting framework to a much lower level than what we used to know many, many years ago historically. And so to now lump on a growth objective where the real problem is infrastructure, lack of skills, those real supply side problems, it just puts the focus in the wrong area and makes it very, as I say, so the fact that we're a small open economy, a lot of volatility in the currency, and the fact that our growth problems are really not rooted in monetary policy but in supply side issues, I just don't think it's a good idea to give the SARB that additional responsibility of trying to sort of lift growth and reduce inflation at the same time.
Yep, I would agree with that.